Dividends are a form of payment made by companies to their shareholders. When a company earns profits, it can choose to distribute a portion of those profits to its shareholders as dividends. These payments are typically made in the form of cash or additional shares of stock. Dividends are a way for companies to share their financial success with their owners, the shareholders. They provide a tangible return on investment for shareholders and can be an important source of income, especially for individuals who rely on their investment portfolios for retirement or other financial goals. Companies that pay dividends generally do so on a regular basis, often quarterly, although some companies pay them annually or semi-annually. The dividend payments are typically determined by the company's board of directors, who consider several factors when deciding the amount to be paid. The decision to pay dividends is influenced by a company's financial health, profitability, cash flow, and future growth prospects. Companies that consistently generate stable cash flow and have a history of profitability are more likely to pay dividends. On the other hand, companies that are growing rapidly and reinvesting their profits back into the business may choose not to pay dividends in order to fund expansion and future investments. Dividends can be classified into two main types: cash dividends and stock dividends. Cash dividends are paid out in the form of cash to shareholders, while stock dividends involve the distribution of additional shares of stock to existing shareholders. Cash dividends are further categorized based on the dividend yield, which is the dividend payment expressed as a percentage of the current stock price. Dividend yield is used by investors to assess the potential income from dividends relative to the stock's price. While receiving dividends can be beneficial for shareholders, it's important to note that not all companies pay dividends. Some companies, especially those in growth industries or early-stage startups, may choose to reinvest their profits into the company to fuel expansion and development. In such cases, shareholders might benefit from capital appreciation if the company's stock value increases over time. Overall, dividends are a way for companies to reward their shareholders and provide them with a direct share of the company's profits. They can be an important aspect of investment returns for income-focused investors and a signal of a company's financial strength and stability.